Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good morning, good afternoon. Welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader. And today, like every other Develop Your Edge, we have Anthony coming on to tell us what is up with trading, how to develop your edge. Anthony's got almost 27 years in the business now, trading. And he will share his expertise with you, the viewer. So with that, I'm just going to bring Anthony on. Welcome back, Anthony.
Tom, everybody, great to be here today. This cold I have is lingering, so pardon my voice throughout today's discussion, but I'm feeling pretty good, good enough to be here and to talk about trading this breakout rally without chasing it. I'm really going to focus in on a squeeze look today when we get to the charts.
Awesome. Thanks for that, Anthony. And, sorry to hear you're not feeling well, but I know we'll get through this and look forward to this topic. It's exciting. Jim kind of talked about it this morning on the opening range show, and he's here watching. So we're all excited for this topic.
Yeah, Jimmy's great. And, first off, I think we have to recognize when we're in a breakout type rally. And I know that sounds so basic, like, oh yeah, sure, Anthony, I know exactly when we're in a breakout rally, but it's pretty incredible. You can go on Twitter and you could put a chart out there and you can say, is this market in the bull mode, or is it ready to sell off, or what is it that you see? And if 100 people replied, I wouldn't be surprised if you got near 100 different answers on what people saw in the chart. And that's just what trading is, right? It's always in the eyes of the beholder. And when you look at the market, it's hard to look at the market in a way to where you really don't have some sort of underlying bias or opinion. And so for me, what I like to do is I like to go to a daily chart and just have the market tell me something, have it prove to me something, right? Without me having to think anything about what's going on in the marketplace and all the different noise. I just want to go there and go, prove to me something. Are we in bull mode? Are we in bear mode? I talk about these different market environments and how I think this is the most important aspect of really coming in, I think, and becoming a successful trader is those three market environments: range expansion, bull or bear, consolidation, or mean reversion. And I put a tweet out. I did a whole real video on this as well, on how I felt that we were now in range expansion higher. And I put this out about 5 days ago. And when we get to the daily chart, I want to explain why I believe that we're in range expansion. And I want to talk about how we then take that mindset from a daily chart, because the big picture supersedes the short term, and how we go in and trade that without chasing it. So let's pull up this chart here on the daily. And the first thing that I want to look at is Bollinger Bands. People have asked me on Twitter, even in the Discord, what are my Bollinger Band settings? 20 period, 3 standard deviation. I'm not using the middle Bollinger Band. I'm just using a 5-day moving average. The 20 period, 3 standard deviation Bollinger Band, you're going to be using the 20 period moving average. And so I just don't have that in there. I don't want to see it. I don't need to see it. And so that's what I have up here. Then what I do is I take that Fibonacci retracement and I draw it from the bottom peak to the top peak. And that tells me that we're boxed in this area. And anybody who's watched this show knows, if you go back to the beginning of January, I was short the E-mini S&P for several days, and it was because it was mean reversion. Then we got into consolidation as we chopped sideways. We got back above the 5-day moving average, And then the top Bollinger Band went from pointing inward or flat to pointing outward. And that's why I have this arrow drawn here. And what's also very interesting and which really confirms that we're in range expansion is if you look at this old Bollinger Band peak, the market has made a higher high over this previous highs, okay? Everybody can see that. But what's interesting is this top Bollinger Band now is at or even above this previous peak. And so what that tells us is that it's confirming that this range expansion is very likely now, has a high probability of going to test this previous peak. I've talked about this as unfinished business, which comes in right around 49.74, 49.72 is where that top Bollinger Band is now. And so there's a very strong likelihood that the market gets back up into that area and tests that previous peak. And we are probably going to be in range expansion for who knows how many more days. We don't know, but until further notice of when that Bollinger Band starts to go and get flat and starts to come back in, very similar to what we saw here at the end of December, and where the market started to flatten out and the Bollinger Band started to come inward, and then the market environment would change again. But what's also key is, and I put this also out on social media so you can follow this along in my timeline, I'm not just saying this after the fact, is when the market had this spike up and this Bollinger Band went higher, I said, we're really in grind mode now. And it's probably one of the hardest environments, in my opinion, for day traders to come in and do something, is because once you have this big move like we had in the S&P higher, and it just kind of like stalls, it's like this, all of a sudden, all of this volume, all this money has come into the market. And now it's like, whoa, as a day trader, the only thing you can think about is where we came from. And you're like, can I really be long up here? We just had a 100-point move in the S&P in a day. You know, how do I trade this? And the market environment changes in that moment to that range expansion, grindy upward move. And it's easy to buy into a rally thinking, oh, I should finally get in now. And you kind of end up getting chopped up. And you could see this market this week, if you really look at it on an intraday basis, nothing, I would say, intraday was so clean and like you just bought the open and it went higher. There's a lot of days where they were squeezing lower, and that's the trade. I actually talked about this in my live stream on Monday afternoon in my Discord. This is all free, and we follow up with all of these conversations here on Develop Your Edge. In there is look for that squeeze trade. So the mindset is we're in an environment where the market's just grindy, squeezy higher, right? And so if that's the case, as a day trader, I got to be really, really super picky in how I approach this day, because it's a one-dimensional tape, higher only, one time framing. Some people will call it higher. And you look at it and go, well, how do I step in and how do I generate alpha? How do I make money in this trade? And Tom, I think before we even get to that, I want to just get to you, because you're the CMT. You have a wide range of expertise on technicals. Defining a breakout, I mean, there's several ways to look at it, and it could be just price making a higher high, but it also can be other things.
Right, for sure. So, love the Bollinger Bands. I think the way you interpret Bollinger Bands with the expansion of volatility, which translates to a trend, is the way to go. Now, you don't have traditional Bollinger Bands on. If we were looking at two standard deviations, you might have seen a breakout. When we talk about Bollinger Bands, a breakout would be above the top band. A breakdown might be below the lower band. But I like the way you use the third standard deviation, because it gives you kind of that field that we're playing with, right? So, right. And so that big day on Friday, that big move up, closed outside of the bands. And, some people look at it at mean reversion, except when you're going from a tight range and you break out of the band, that to me is a true breakout. That's meaning we're going to go up. So, I don't want to, change the way you're looking at the Bollinger Bands. You're showing it how most people look at it with the two standard deviation bands. So, traditional Bollinger Bands, that's the interpretation. But it's the same concept. You're breaking out of a range. And that Friday was options expiration, don't forget. That 4,800, call wall was keeping the market down for how many weeks? I mean, 3 or 4 weeks. Well, not 3 or 4, maybe 3 weeks. And then options expiration, that might have let the lid go too. So we could break out of that limitation on the Bollinger Bands. That's just what I see. It's a culmination of not just the technicals, but it's also, the options expiration really did have an impact here.
100%. And I'm glad that you brought up the 2 standard deviation, because that's the traditional way to look at it. And if you look in the past, you could see how we spend so much time above the Bollinger Band. And a lot of people will look at Bollinger Bands strictly as a mean reversion type look, where when you violate a Bollinger Band or hit a Bollinger Band to come back down. And I go back to the reason why I changed it to a 3 standard deviation is, and I'll change it back here. And the reason is because my weakness as a trader was fading moves. Anytime we would get into a range expansion move, I'm the guy there, Clicky Ricky, in the E-mini S&P. That's an inside joke kind of in the Discord, where I'm clicking and I'm trying to get short against the grain. And I would be the guy who would just be death by 1,000 cuts, trying to make a couple of ticks here and there and just getting run over. And, I said to myself, what can I do to prevent that? And I think that's where most traders are going to find their best work. Find scenarios where you prevent yourself from being against very powerful trends, put indicators around them to help you better. To me, at the bottom line is, when you find less ways to trade, that actually puts a stronger hand in the positions that you do have. And so if I'm just trying to trade 50 times a day and I'm trying to just make a couple ticks here and there, you ended up getting grinded into a pulp most of the time. And ultimately, you end up on a path of losing. If you know what direction not to be in, you can be pickier. And when you come into the day, you can find a way to make money in that direction. And that's ultimately what I'm trying to do here. So when I see that this is, the volatility is expanding, it smooths it out for me. I then go to the short-term charts. And this to me is what I think is one of the best trades that you want to look for anytime you get in a range expansion. And you have to believe in your homework here. This is the key. You have to believe in your homework. You have to believe that we're in range expansion, because your belief is truly going to be tested when you get to the short-term charts. And when you get to the short-term charts, you're going to say to yourself, I'm going to wait for a break to buy, and I'm going to have to actually step in and buy it. And what do I want to look for? I want to look for high volume to the sell side, a break of a 2 or 3 standard deviation to the downside with a strong cumulative delta pushing against it, and look for that move right back into the range. Why? The reason is because if I believe that my big picture is going to supersede anything I'm seeing on the short term, then I want to be buying the potential of a breakout lower and to look for that to come back into the range. That's the squeeze trade. So you see sellers come in and accelerate to the downside, and they can't move past a 3 standard deviation. That's a really tight risk stop area for the market to revert back into a 2, 1, or even VWAP for the day. And so this, to me, it's a trade you have to sit around and really be patient for. And so what do we look for? We look for bars with high volume lower here. Cumulative delta shows you it gets to 3 standard deviation. It really can't push much through it, or it comes right back in it. That's a step in buy, lean on that low, come back to 2 or 1 standard deviation, or eventually back to the VWAP. This is my favorite look in squeeze grindy markets, because you're going to take that volume of that sell, that puke volume, where people are going to step in and go, well, I can't hold them anymore, or I think we're finally going lower, and the market stops progressing lower and comes right back into range. That's my favorite look. So you have to wait for that bar to either close, you have a 3-minute here, or you wait it to come back into the 3-minute or the 3 standard deviation bar. You work your stop below it. You look for a scalp to back to the 2 standard deviation or 1. And I highlighted some of those throughout the week that we saw. Another one here, down to a 2 standard deviation. Bang, big volume coming into the sell side. Can't get below 2 standard deviation. Squeeze back in, eventually up to the VWAP, right? Over and over again, you see it. You're not buying rallies here. The reason why is because the big rallies already happened. So now you're going to have this grind tape. And so you're going to have these days where people are going to come in and there's going to be some sellers, people that have made a lot of money, some people that are using futures to hedge. Doesn't matter the reason, but at the end of the day, you're looking for those little squeeze traps lower where even the day traders are like, we're going lower now. They all come in and hit the bid and it comes right back into the range and you're like, uh-oh, and they bid them back up. And that's what we see over and over again. And you see these a lot near the open where you pierce that 3 standard deviation, suck back up to the VWAP. Down to the 3 deviation, volume comes in strong to the sell side, suck back up to the VWAP. Over and over again. And I have been very clear about this in the Discord. And like I said, I talk about the Discord because it's free and it follows up a lot of what we discuss here and Develop Your Edge. Here's another one, squeeze down to the 3 standard deviation. Big, strong volume comes in, squeeze right back in. And then here we go. You know, I mean, it's one of those things you see over and over again in the market and in these grindy trades. And you don't want to do it. I go back to it. You don't want to really be doing it at like a 1 standard deviation. You want to look for a 2 or 3 standard deviation. So you have to really be patient because you're really look at this saying on this order flow VWAP, we're not going to get more than 3 standard deviations away from a VWAP from the regular trading hours open on a day that we should really be squeezing higher. That's why I said you have to believe in your homework, because if you don't believe in your homework, you think this could be a trend down day. Now, a lot of times, if I think that we're in range consolidation or if we are in a breakout to the downside, I am actually using that sell volume on that next bounce to get short and continuation of trend. So I'm believing in the original homework. This time it's different. Now you're using the sell volume, that squeeze volume, as an opportunity to get in. Squeeze to the 3 standard deviation, suck back to VWAP. And you got to be super patient with it. Here we are with today. Look at this one right here. Another one where you'd probably look at it and say, maybe you can get in there. You didn't quite get to this 2 standard deviation. This is for today, which came in at 49.11. I think we stopped at 12 even. But if we would have just went down there, kissed that, look at this cumulative delta bar. Strong volume to the sell side, comes in, and the market just gets sucked back in. Everybody's looking for a reason to sell, but you as a trader, you believe in the higher time frame. So you look at that and say, I want to look for the squeezes when they're selling to buy that and for us to come back into the range. That is my favorite look when we have that set up on the daily and how we go in and execute it on the short term.
So Anthony, quick question. It's easy to see on the chart, 2nd standard deviation, 3rd standard deviation bands below. Is that cumulative delta necessary for this trade? Meaning, if we get extended to the 2nd or 3rd side and we don't see that big volume coming in on the sell side for the cumulative delta, are you still thinking about, well, you know what? It's kind of extended almost to the 3rd deviation. We know we don't really get past that almost ever. I'm gonna start to think about going long here. Is that a possibility as well, or do you really? I mean, you really like to see that volume, but if it's not there, do you still go long?
That's the perfect question to ask on this, and the answer is without the volume, I don't even want it. And the reason is because I want to see a surge in volume. Think about it from a market maker's perspective. Market makers are making bids, market's getting sold into them, and all of a sudden the selling stops. The market makers start working the bid right back up, right? They just got filled long. They're now bidding it back into it. You look at big players, right? Big traders. Anytime they see a squeeze, anytime a low is made, you're going to have, you just look at it from a volume profile standpoint. You've got that middle, that bell curve looking thing, and you get to the edges. I want to participate in the edges. So if it's a high volume bar lower, and then all of a sudden it comes back in quickly, that to me is what I would consider a good low, right? If the volume is grinding down to a 2 or 3 standard deviation, that's not a good low to me, because I like mini capitulations within primary trend, right? And so the volume aspect is so important, because you can see that if the market is trying to push through with high volume and it doesn't have success, you have those that are short that now want to cover, that maybe they didn't get the low. You've got market makers that have been working the bid on the way down. They just got hit, and all of a sudden the selling stops. They take it back up. They're just going to bid up. You're going to sell me here. You're going to sell me here. No. And the market goes back up. It gets squeezed back into range. You get those that have been waiting to get long. say, that's a good low. I like that low. Let me step in and buy them. And so you have that psychology across multiple different players in the market space, right? And that's important because if we're grinding lower, anytime a market is grinding towards a high or a low, I typically don't want to go against it. I want to go with it. I only like pierced lows and pierced highs if I'm looking for a scalp, right? I don't want, if I'm grinding lower or grinding higher, I most likely am going to be grinding with the grain, not against it.
Okay, good. So right now it's looking like there might be a setup similar to what we saw about,
Very similar.
a little bit ago, where we've got that volume increasing on the cumulative delta to the downside. Well, now we have a new candle. But
Oh, this
maybe
is a good point. But I want to go over this one real quick here, Tom. So
sure.
here's something to look at, and then I didn't. This is interesting here. Anytime that the standard deviation lines are flat like this, you have to be very, very patient. So I've talked about this before. Anytime you have standard deviation lines that look like this, that is very much acting like a two-way tape. So you have to bring your short-term hat down a little bit too, and you have to come in and say, okay, now let me draw my line as we get into, current day here. And that's the opening range high, okay? And now let's take it and we'll do something on the opening range low. Now, and I noticed this right away as we're doing it, I didn't have the lines drawn. We are trading within opening range where the VWAP is as well. In this scenario, what you have to do is I go back and look and I'll say, okay, now that this is the case, this is setting up as what I would consider a range day. I really want to see it down to the 3 standard deviation. That's my look instead of the 2. Now, the reason is because the 2, I really can't manage risk too well here. Like this spike, unless it like spiked like halfway to the 3 standard deviation and came back above it, I'd have to really be careful here of just buying 2 because I want my stop outside of the 3 standard deviation because the lines are flat. And so because it's a two-way tape, we might press the outer edges. I go back to this. What you're trying to do here is you're trying to pick a low on a squeeze lower in an overall upward trend. This is for scalpers. This is for intraday trading. This is that type of mentality, right? If you're somebody who is not very active, this is not something you're even going to look for. But I, as an intraday trader, I'm going to look at this and say, if we blip down here, I'm going to watch that volume. If I see it just pierce the 3 standard deviation flat and get right back above it, I step in and buy and immediately put a low below that stop. Now, they might one tick me a couple times here and there, but if all of a sudden this thing starts to revert back up, I'm trailing out at 2 standard deviation, 1 standard deviation. Maybe I leave some trailers for the VWAP, but overall, I probably got my trade at relatively low risk because we're very close to the stops. And so we have some time here. Let's watch and see what happens. I don't have my dome open today. Otherwise, I would actually trade. This is actually a perfect scenario for me, but let's just maybe we wait and see what pans out here. I know we've got a few minutes left in the show, and I don't know if you have any questions on this.
Well, I think, we talk about the flattened VWAP bands. I look at them similar to the Bollinger Bands. They're constructed differently, different calculation, but same concept. It's a little bit of volatility, right? So if we're talking flattened VWAP bands, sometimes you see the VWAP bands moving in, right? Which doesn't always happen. But to me, that is a very good indication that, this is a sideways market and it's not trending really that much at all. Now, anything can happen, as we know. Market could fall out, market could rally, but using those bands for stops or targets, they're going to be very tight.
No doubt. And what's interesting right now, you see cumulative delta continue to grow to the sell side, which it's expected as we're starting to push towards we're at all-time highs, right? And there's going to be sellers out there. Remember what futures markets are originated for, they're to be able to hedge your risk. And
Right.
so when you look at it from that perspective, you've got people that are along a boatload of stocks right now. They can sell futures against their portfolio. And, and so it's not uncharacteristic to see a market at all-time highs and see the delta negative, right? But the thing is, that's what goes back to why you have to be really picky and why you want to be on the edges. You want to see the squeeze selling come in to where people go, okay, let's pause on selling. And it goes back to those people that I talked about that might step in and look for the rotation back in. But you have to be picky and patient about it. This is not really a very systematic approach at all, right? This is one of those things where you have to be around for a little while and you have to watch this action to really understand how to step in and do this, right? I like to get a little advanced and develop your edge, because instead of me sitting here trying to just figure out how to trade this tape all day long, and a lot of people are out there, saying, well, this has not been, maybe it's been a difficult tape for them. This is a good setup just to sit back and wait for. Squeeze to the edges. Stops are relatively tight. And if you're right or wrong pretty much immediately, right? I mean, if it were to blip down to 3 standard deviation, I'd see this bar come down, pierce it, and I'd see it get back in above it, and I'd buy it. Or if it stopped on a tick there, and I'd buy some. My stop is going to be relatively close to where I entered, maybe a couple points at most. And I'm only going to be looking to make maybe 2 to 3 points initially on that trade, because I'm going to try and get out at least of half the position at the 2 standard deviation. Now, some would say, well, why would you do that if you think maybe you bought the low? Because I want to take my risk off as soon as possible. And I want to do that because you just don't know. I'm never that confident in anything to where I don't want to take my risk off. It doesn't matter, especially when I'm trying to do some intraday, rotational trades, which is what this is. I don't know if this is the low. You don't know if this is the low until the bell rings. So when the market comes down there, I'm just going to step in, get my 2 to 3 points, rotate out of it. And if I see the response is good, I'll try to hold some to maybe the next standard deviation or the VWAP, but I am not going to let that trade get away from me. Bottom line is I'm just trying to put a winner up right now, because let's face it, these days are sideways, grindy, volume's been down. The bulls have this big picture objective, I think, to probably get up to 49.70, maybe even 5,000. So, I don't know how long that takes. So in the meantime, I'm going to step in the areas I think for a day trade and look for those little squeezes. And just one quick thing before I bring you back in. Look at how the volume continued to try to push the market lower today and couldn't even get below opening range. Now, that still might happen, but once again, this is why I like volume, because when you have cumulative delta at any level that you're interested, a level of interest, and if it doesn't get through it with selling, it's actually holding as support, right? And so it's just something to keep note of. It's why I love cumulative delta.
That's awesome. That's great. This is what's interesting is you have a longer term target. Sometimes the day doesn't play that way, but you still have that in the back of your mind. Like, this is where it's going. This is where you think it's going because of that daily chart, but not every candle we know is going to play in the same way. Nothing goes straight up, nothing goes straight down. So I really like, the way you adapt to what's happening on the ground.
Absolutely. I know we're running out of time. I want to mention, I know we talk about ES a lot, and I actually have done some live sessions here with the micros, which is really what I'm going to be looking to do a lot in February, kind of tying a lot of what we did in January and do some live trading sessions on Develop Your Edge in February. Remember, there are the micro E-mini S&Ps. Those of you that are new to futures, this is where I would start, because it's only going to be it's a much lower margin, right? And you're only going to be at $1.25 a tick versus $12.50 a tick in the ES, and that's the micro E-mini S&P. So today you saw me charting on the ES, but don't forget about the micros. And I go back to also why the micros are such a great tool. Maybe some of you have bigger accounts and you can afford to trade the ES, or maybe you're newer to trading and you're like, you know what? I kind of like what Anthony's saying. I want to go out there and trade this. You can trade 1 to 3 lot micros, and you could probably be risking in these scenarios a point or two. And so you're looking at, under $50 to $100 worth of risk for these scalps. And ultimately, I don't think you necessarily look to really try and make a lot of money with this. You look at it to start testing yourself and testing that strategy under live conditions. And that's one of the things where I think the micros are a really valuable tool, aside from just, I think, a good product in general for traders to come into the futures markets. But they're great places to test your strategies, because you can ease in with 1, 2, or 3 micros around these areas, and you could build a little bit of a playbook, and you could build a little bit of a journal and see how things have worked for you.
Totally agree, Anthony. Thanks for that. New traders, especially, micros are your friends, and exactly what Anthony said. Good way to use, it's different from sim trading, right? Sim trading, you can do so much, but then when you have real money on the line, it's a whole different ballgame, and micros help you make that transition to becoming from a sim trader to a real-time, real money account trader.
Yeah, skin in the game is key.
Yeah.
Absolutely. And I know before we go, I talked about the Discord. You can find the link to the Discord in the description, in the YouTube description. Also go to anthonycrudele.com. There will be a link there. And also, if you're on X, I'm getting used to calling it X now. I don't know why, how this has happened, but if you're on X, I'm at Anthony Crudele. Watch out for the imposters. Unfortunately, I've got a bunch of them, but you'll see which one is me out there. Just make sure it's me. And there's also a link tree in there to take you to everything else that we've got going on.
Anthony, they don't even care anymore. It's not like they're substituting, putting two L's in your name. I've seen completely wildly different names, but still your picture. And I know, okay. I report them. I always report them. So, but thank you again for what you do. And thanks for being on the show. It's great to work with you. And then thanks to the viewers for coming. Next week, we're going to take a break. I think we'll show a rerun, right? And then we'll be back in February.
That's right. I am out next week.
So great, rest up. You sound better than you did at the beginning. So maybe better things on store for you. But I want to thank everybody for coming, and we will finish the day today. Normally we'd see Mike Burke, but I will be filling in for Mike Burke at bars closing. In the meantime, have a great trading day.